Jolyn, we are live. I think you're muted, by the way.
I was muted. I'm trying to share the stream. How goes it?
Uh, it goes well, lots of transition taking place here at Monroe Manor. Some
Mm-hmm.
things will be happening. But yeah, everything's good. Everything's good. Very, very interesting day in the market, which we'll get into in a little bit. But
Mm-hmm.
yeah, shout outs to you. It's so funny how it's like we're always coming through like on days in which that we wear black.
I know, and it's
And we
funny because
don't plan this.
we don't plan to.
It's like, I feel like today is like a day of wearing black day. It's like
Well,
a
I
black
try to
day.
add some color because, like, I was
Well, every day
told
is a
to
black
be.
day, but
I mean, oh yeah, all black all day. But okay, I have updated all the social media channels. So anyway, today was a day. Are you ready to get into it?
yes, let's do it. So, what's up, everybody? I'm Mark Monroe, accompanied by my wonderful co host, co producer, co creator, and all things galactic. And of course, we're going to keep it black and yet keep it brief. Give it up to the wonderful.
It's Jolene GC in the place to be. What does it, cousins? I hope you are doing excellent on this fine Tuesday.
All right, all right. And if you haven't subscribed yet, go ahead and hit the subscribe button down below. And on top of that, if you like this video, then apparently it will tell YouTube's algorithm to stop hating and get it out there to a bunch of other folks that definitely need this information and knowledge. So, maybe we can do some things there. And then on top of that, if you want to be in the know, like who was first in the chat today? Do we know? Do we know?
Yeah,
Anybody?
it was Reggie P coming through super early. Notifications
Well,
on.
shout outs to Reggie because we actually got the receipts now. So, Reggie, you were the first person in the chat. So, we salute you and thank you for having your notification bell on. So, if you want to be like Reggie, aka a part of the notification squad, as well as the Cool Kids Club, go ahead and hit that bell so that way you could be just like him and we can shout you out. All right. So, Jolyn, what's good? How did we do in these markets?
Oh man. All right. So the Dow was up. It was doing this thing, was up 338.30 points. So now, y'all, we are at a level of 35,000 and some change. We got the S&P 500 up 56.08 points. We're now at 4,631.60. And the NASDAQ coming in with a respectable 264.73 points. We are now at 14,619.64. The VIX came down to 18.90, and the U.S. Treasury note is up to 2.407%. Heading over to sector performance, as you know, there are 11 sectors, and we track the top 3 and the bottom 3 so we can see what that rotation is looking like. We have real estate, technology, and consumer discretionary holding it down for the top 3 spots. And in the bottom, we have health, financials, and energy, the only sector in the red today. Heading on over to pick performance. As you know, we just released these new picks. You can find all of those picks on our Instagram page at That Come Up Series. We have Twilio, Unity, and TQQQ all holding it down over 5%. Twilio was up 8.55%, Unity was up 5.92%, and TQQQ up 5.12%. Now, for the bottom feeders, we have United Health, Diamondback Energy, and SQQQ. So United Health was negative 0.48 percentage points, Diamondback Energy negative 1.40 points, and SQQQ negative 5.11%. So you can see that range. We got over 8.5% for Twilio and SQQQ negative 5.11%. So we've had good days back to back. So we'll see how this, shakes out tomorrow. We'll see if it holds. We'll see what's going on, because I heard that there's whispers, recession. So y'all, we'll talk about all of that kind of stuff later on in the show. But, just pay attention to data. And that's what I'm going to say.
Facts.
Narratives especially media narratives can throw you off. So shout out to Brian Clyette for our Black History Corner. You know, we like to keep rocket all the way till Juneteenth. Let freedom ring all the way to Juneteenth. So let's talk about, we're going to talk about Madam C.J. Walker today.
Hey,
So who was Madam C.J. Walker? Madam
entrepreneur.
C.J. Walker invented a line of African American hair products after suffering from a scalp ailment that resulted in her own hair loss. She promoted her products by traveling around the country, giving lectures, demonstrations, and eventually established the Madam C.J. Walker Laboratories to manufacture cosmetics and train sales beauticians. Her business acumen led her to be one of the first African American women, or just American women in general, to become a self made millionaire. She was also known for her philanthropic endeavors, including a donation toward the construction of an Indianapolis YMCA in 1913. Walker's life was portrayed in the 2020 TV show Self Made, with Octavia Spencer portraying Walker. Walker later died of hypertension on May 25th, 1919, the year my grandpa was born, at age 51 at Villa Lauraro. In 1981, Madam C.J. Walker manufacturing company ceased operations. A line of cosmetics and hair care products bearing the name Madam C.J. Walker Beauty Culture is available at Sephora retailers. Walker left 1/3 of her estate to her daughter, who would also become well known as an important part of the Harlem Renaissance, and the remainder to various charities. Walker's funeral took place at Villa Lauraro, and she was buried at Woodlawn Cemetery in the Bronx, New York. So I will note, Mark, that Madam C.J. Walker, her business model of training the beauticians and doing direct sales is the same model that has been used by all of those direct marketing companies. So think of, like a really good one would be Mary Kay. So that line of like consumer to consumer direct sales, that was from the brilliance of Madam C.J. Walker. So, you know, all those sales companies have the culture to thank for that. So it's not really talked about, but we're known for innovation. It's in our DNA. So,
It
um,
is.
so Mark, today the show, it's all about that implied volatility. I know there were several questions today about, rumors in the market with recessions. There was talks about recession signals. There was talks about, there were questions rather on how to prepare. All these different questions that I think fall in line with what we're going to talk about today. So that's great. So I'm just
Okay.
letting you know there are a lot of questions. Some of them are overlaps, but a lot of them, there's a lot. I'm like, I'm
Okay.
still scrolling through.
Okay. So where should we start first?
Let me see. Oh, there's a question for you, Mark. Is that Come Up Series hat available for purchase?
It will be soon, along with a few other merch items. We actually switched merchandise providers, or we're in the process of doing that. So the existing merchandise stuff is still technically available, but pretty soon we're going to be switching it all over and redesigning and getting some new stuff in there. Yeah. So there you have it.
Oh,
So
there was a cousin who hadn't been joining us for a minute, and then she came back. And I'm trying to find her because she was in remission. So I wanted to shout her out, but I can't find where her here it is. Hold on. So her Twitter or her IG handle is Evan SEO4.
okay.
So Evan SEO4, glad that you're back with us and glad that you're healthy and strong. So thanks for coming back. Welcome
We
back to
missed you.
the family.
Okay. Yeah. So where should I begin?
Oh, that was the question, eh? I think we should begin like maybe 3 seconds after the very beginning.
All right, so let's talk recession real quick.
Mhm.
The number one question I'm probably guessing that everybody wants to know, are we headed for a recession? So much to unpack here. So, given in the sense that pretty soon I'm going to be in little bit of transition. I'm not going to be able to film a bunch of stuff, so which means that I'm going to be doing a lot of dumps of data and information to each and every single one of you when it comes to making sure that you have the knowledge and not waiting on me to do a pre-recorded episode. So a lot of times you're going to be catching it like I'm coming in hot. So hopefully, this suits everybody as a quick little breakdown. So are we headed for a recession? One, short answer, in the short term, no. Long-term answer, meaning anywhere from 12 months to 24 months, very, very possible. Now, what is causing that? Now, a lot of the things that we see on the high side is, of course, inflation on products, supplies, and then on top of that, wage inflation. And then, of course, everybody's like up in arms, like, okay, hey, well, real estate, now we're starting to see mortgage rates climb above 5%, where once upon a time it was like significantly low. So are we headed there? Yes. Is this normal? Yes. It's actually funny because a lot of times people get spooked when we hear the word recession. But in reality, when we think about recession, that's just a way, and it's just a way of being able to explain that the economy is coming to a slowdown. We go through periods of growth. Think about it like as if the economy is a sprinter. And if the economy is a sprinter, then they're going to give you the best that they got. If, shout outs to the 400-meter runners out there. But, and if you run the 800, you're just weird. But, I salute you. So pretty much what happens is that you start to run out of gas and you start to slow down. I mean, if anybody has ever sprinted before, you understand that essentially you give it the best that you got. And even if you're the best 400-meter runner, you start to slow down. You're not picking up any extra speed because of the fact that you just ran a hard 300 meters and coming into the final 100, coming around the wall, you're definitely hitting that point. Now imagine the markets in that same type of manner, or the economy in that same type of manner. When you have significant boost as it pertains to quantitative easing and stimulus and everything else, you're just given an adrenaline shot. Or, well, I'm going to keep it PG today. And so, because, I could have gone PED, like performance enhancing. But, we're going to just say this. Now we're coming to this period of time where we've had all this significant expansion and growth and expansion. And now we're coming to this place where we're starting to see the economy slow down, aka the sprinter is slowing down. It doesn't mean that we're not going to make it across the finish line and take a small little breather. We're going to do that. And then during that period of time, you typically see that things are a little bit slower. So it doesn't mean that the economy comes to a standstill like COVID, made everybody do. But it just means that essentially that the growth, so aka GDP numbers or GDP growth rates, slow down. Let's say some companies, their performance, their earnings growth slows down. And you just see that we tend to go through these cycles and periods of time in which that ultimately it spooks the market, because now investors are like, well, who's going to be significantly impacted? And now it's like, all right, well, now I got to price in all this risk. The last time that we actually saw the yield curve invert was actually in, I think it was April, I think it was sometime in April again in 2019, where we saw the yield curve invert. And here's the funny thing. If you don't remember, 2019 was probably well, excluding 2020's, behavior, the year of 2019 was probably the greatest bull market runs for an entire year. It's not to say that everything was up, but when you look at the market as a whole, it was lit. And then, well, we know what happened after. But if you think about it, in 2018, a lot of folks like to refer back to 2018, but there was a lot of things going on there. Like, a lot of folks realized that the yield curve had inverted again during that period of time, but yet there was also a lot of stuff happening, like the Fed was cutting rates, or the Fed was raising rates very aggressively. In this particular situation, I don't think that the Fed is going to raise rates aggressively. They're going to raise them over periods of time, incrementally. The Fed went from almost, I think it was like 50 basis points, and then, another like 50 basis points or something like that. And that was just like, wait, hold up. The market's just like, whoa, 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 Powell, yo, I understand that you're trying to flex here because you're the new Fed chairman, but Jesus, take it easy on us. And, ultimately it spooked the market. And if you saw what happened at the end of 2018, it hurt. Let's just move on from that subject. So in 2019, when we saw it invert again, the market was like, okay, well, all right, if it's going to happen, it's going to happen. And then ultimately, COVID happened. Now, what does that look like when we think about a yield curve inversion? So when we think about the 2 year and 10 year, so what happens? It's pretty much what happens when the 2 year Treasury yield is higher than, say, for example, the 10 year. At that point in time, you have an inversion. Normally, if you go and look at most of the Treasury bonds, you'll
Mhm.
typically see that essentially that now I'm really self-conscious about something. So I'm going to see exactly how many times I say the word essentially in our shows moving forward. If you've been keeping count, let me know at the end of the episode.
Yeah, it's
Um,
34.
okay. All
It's a
right. I'm going for the record, essentially.
at 35.
Okay. So if you think about it, normally from like starting from like the 2 year or the 1 year and then going all the way up to the 30 year, typically the 30 year is typically the highest. And then after that, it's like, all right, well, essentially you see it like go in a process period where 30 year is higher than the 10 year, 10 year is higher than seven's higher than the five, and so on and so on and so on and so on, except for if we're excluding the short term interest rates like the 2 month, the 3 months, those.
Mhm.
So, with that being in perspective, and also understanding where we are as it pertains to the Fed, also has a significant amount of cap or a significant amount of debt on its balance sheet that it has to essentially move off. And then on top of that, there's rate hikes where we have to get the federal funds real rate uh, back to a set of normalcy. And then, of course, we have waging inflation that's way out of control, though that it's being enforced by the supply side. So that's just a supply side bottleneck alongside with some wage inflation and stuff like that. Um, Now, a lot of folks are saying, well, when do we expect this recession to take place? Now, here's the funny thing about recessions. Most people don't know that they're in a recession until we're coming out of it.
Mhm.
So it's like around the time that you start hearing a lot of the conversations take place, if you're very well in tune into the market and paying attention on the economic side, then of course you're going to be very much so well versed on what's happening in the economic landscape. So you're going to be very aware, and those are the folks who take advantage of not only companies to invest in and to buy into, but also spotting out who are the next potential players that could be the diamond in the rough that you invest in, and ultimately you got the ultimate come up.
Mhm.
So normally when we see that the inversion typically takes place, there's like this read that says that it typically will happen between 12 to 18 months down the road that the market will ultimately realize that we're in a recession. So that's pretty much it in a nutshell. Is it an exact science? No.
Mhm.
Could there be other driving factors? Yes. Is it something to really get spooked over? No, because already we're seeing that the growth in a lot of areas has already slowed down. And you're going to see that as we are just now stepping into earnings season. That's
Mhm.
why I say to people, pay attention to earnings as well as like look in the earnings side, look for the earnings growth, but in the real side, look at the narrative, aka the guidance and full year outlook. Those things will tell you a lot as it pertains to are we really going into recession? So, who are some of the companies to pay attention to? Well, if you want to pay attention to the ultimate, stock market bellwether darling, pay attention to Apple. If you
Mhm.
want to look at things on, say, for example, a wholesale side, look at companies like a Costco or a Walmart. If you want to look at things on an automotive standpoint, not trying to toot my own horn, but beep beep, you could definitely pay attention to Tesla, and then of course you can look at the other folks in whom which that follow, aka Ford and GM, and a few other folks. And then on top of that, if you want to pay attention to even the retail side of things, you could look at Target. You can also look at luxury retail. When we think about recessions, here are the things that typically take place. Luxury spending items typically fall. So, which means that you'll see a drop back in luxury spending, aka, like, for example, look at money. If you realize that money's going to get a little tight, you're not going to be out there spending money willy nilly, though that you shouldn't be doing that anyways. You shouldn't be loosey goosey with your cash. But if you are out here, then the recession should be your wake up call to say, okay, hey, maybe I need to get a little bit more smart with my money and let my money start moving correctly. So those are some of the things to pay attention to when you start seeing that those types of areas or those arenas of spending start to slow down. Then that can let you know that we are in a place of headed towards a recession. But if you don't see those things, then
All right.
move on.
Well, You had mentioned earnings, so there were some questions about Restoration Hardware's earnings. So, they closed today at over 385, and then they went down to the 369 in the aftermarket. And
Uh-huh.
they announced that 3-for-1 split. So people want to know. We could take a look at the briefly.
I knew you were going to get me with it.
Yes.
Okay, hold on. Let me go ahead and pull it up. So I think that's their was that their Q4 earnings that they reported, or their Q1?
I think they're in Q1, I think.
Yeah. Let's see here. And I should have been ready. I knew it. I just knew that Jolyn was going to come for me today.
I'm not coming for you.
I know. All right, so let's see if I can go ahead and share the screen for you guys. Share a screen, a window.
Something.
I know, right? A smoke signal. Okay, check me out. Check me out. All right, so let's go ahead and increase the size of the print. Hopefully everybody can see that. All right, so pretty much they published it a few hours ago. So yeah, it was their Q4 2021 results. I felt like that was it. All right, so let's get into it. Hold on, this is not correct. I knew I had the right site, and I knew I had the right earnings, but sometimes you just gotta believe in yourself.
Hmm.
What? All
I'm,
right.
I'm laughing at butter now. That was brought up.
This guy.
Hella unbothered.
Very unbothered. All right, so here is their Q4 earnings. Let's go ahead and just get to it. So 2022 year of the new. Oh, sorry, my
It's hella
bad. All
annoying.
right.
Mhm.
Hopefully everybody can see this, and we'll just throw this up on the full screen so that way we can do that. All right, so here we are looking at, we generated 97 million in free cash flow in the quarter, 477 million for the year, inclusive of 191 million increase in inventory, in which approximately 60 million is due to increased transit times and the balance target to alleviate our unshipped demand backlog. So, okay, they have a significant amount of backlog. They brought in a significant amount of cash. Their quarter was amazing. And on top of that, this includes the fact that they had to significantly increase inventories to make up for that demand. So that's dope. We ended the year with 90 million of net debt and nearly 2.2 billion of cash on our balance sheet. So let's run that back here real quick, just for perspective. So if you look at, say, for example, 90 million of net debt and nearly 2.2 billion of cash, that lets you know that essentially that nobody, like, in a world in which that a lot of folks are nervous about companies having, debt on their balance sheet, or say, for example, whether they've taken out loans or whatever it is, at low interest rates. They're saying that, okay, hey, that they could be possibly folks that are targeted in high interest rate environments. But there's this beautiful thing called $2.2 billion of cash on our balance sheet, while generating 73% in 2021. So that's very much so strong. And also at the same token, this is letting you know, because here's the thing. Ain't nobody out there, like, everybody's not out there checking for restoration hardware when it comes to, say, for example, furniture, because if you've seen that price tag, that may be above everybody, a lot of folks' spending limits out there. So again, when we think about it, that's letting you know that the luxury consumer is very much still strong, because instead of you going out there to buy a couch over there at IKEA, like what you would probably pay, like, let's say $600 for, you're going to pay for a couch at Restoration Hardware for probably about maybe 3-4 grand at a starting point, just as a heads up. So let's go a little bit further, like the year of the new. So, pretty much opening of Restoration Hardware San Francisco. Okay, that's great. Launch of Restoration Hardware Contemporary, the most compelling and potentially disruptive product introduction in our history. We'll see about that. Expansion of Restoration Hardware Interiors and Modern. So that should be very interesting, because now they're getting into the world of collections, so where they're starting to curate their own. which is very much so huge because then it kind of starts to cut the middleman, where you can increase those profit margins. So as you can see, unveiling of our first guest house in New York, a revolutionary new hospitality concept for travelers seeking privacy and luxury in a $200 billion North American hotel market. Interesting. Um, wow. I just want to say that there. And let's see here. Let's keep going because we have a lot of, I love it when a company brags, but after a while, you want to get in a little bit into the details. So the expansion of RH brand globally, beginning with the opening of England, the gallery at the historic Einho Park, a magical 17th century 73 acre. So clearly they're getting into some of the real estate game here as it pertains to their expansion. So that's dope. So let's look at their outlook because that's what really matters, right? So while we enter 2022 with confidence that our efforts will continue to elevate and expand the restoration hardware for brands to come, we also recognize that there are several external factors such as record inflation, rising interest rates, global unrest that create uncertainty. Although we lack the ability to predict the economic outcomes on a macro scale, we do have the business model, strategy, and balance sheet to take advantage of opportunities that may present themselves, whether it be during times of economic expansion, contraction, or dislocation. That right there is game, series, match right here. Like,
Talk on that
look
talk.
no further. Like,
Mm.
if you want a company that literally just talk their talk, then this company just did that. And so, while first quarter sales and margin trends remain healthy due to ongoing relief of our backlog, so they're going to be hitting that backlog. So a lot of that stuff has already been paid for. They just can't realize those gains yet until product has actually gone out to the consumer. We have experienced softening demand in the first quarter that coincided with Russia's invasion of Ukraine in late February and the market volatility that followed. We believe it is prudent to remain conservative until demand trends return to normal and are providing the following outlook for the first quarter in fiscal 2022. Now, this is probably what sent the stock downward in the aftermarket. So, though that you talk that talk, and I want y'all to not forget about this, but at the same token, I like the fact that what they're doing is, and this is what we call a terminology called sandbagging, because a company is going to sandbag their earnings to bring down expectations, and then possibly next quarter you could be seeing, not next quarter, but look towards in Q2 where you could possibly see that the company has a major blowout quarter if by chance that one, there's still more backlog, two, essentially that orders are still up, so which means that the consumer for restoration hardware is still very much so strong. So they said first quarter net revenue growth is in the range of 7 to 8% versus 78% last year, with adjusted operating margin in the range of 23 to 23.5% versus 22.6% a year ago. Fiscal 2022 revenue growth range 5 to 7 versus 32% last year. So you can see that that's a huge significant drop because you went from 30% to single digit growth. But, of course, we have to look at it like this. This is still considered probably your COVID-19 backlog, which will probably play out again in the first quarter. And then after that, essentially, we could be seeing that essentially that we get back to a form of normalcy. Our outlook is inclusive of opening the San Francisco in late spring and then the guest house in early summer, England in mid to late summer, and Palo Alto in the fourth quarter. So these are the areas in which that you look for as their growth drivers and moving forward. And outside of that, we already know what the restoration hardware ecosystem is. It's very, very, one is very dense. At the same token, it's very much so essentially a thing in which that they built a strong moat around it to well insulate the company. So as long as they're luxury clients and you're starting to see that they're opening up other tier models, as long as those models stay strong and that the fact that those growth models actually work, and you probably won't see those things really take shape, form, and fashion in 2022, but you'll get an early glimpse of those things in 2023 where you start to see some of that revenue come out. So that's pretty much it for restoration hardware. All in all, solid quarter on a great beat on the top and bottom line. I think the biggest thing that ultimately spooked investors was really just the fact that, hey, they came in light on their guidance and also acknowledged the fact that there are some economic factors that are looming. And that's something that you want to look for as a trend in moving forward as we continue this year, especially for Q1 earnings.
Okay, so can we transition in our last 29 minutes to
Sure.
presentation mode?
Of course we can. Transition. Okay. Can y'all see it?
Yes.
All right. Ladies and gentlemen, I want you to check out Implied Volatility and the VIX. All right. So a lot of times we know about implied volatility. You probably have seen, well, many people don't really know about volatility or implied volatility when they look at their options chain. They tend to see it there, but they tend to skip right past it, which is pretty interesting. And then on top of that, a lot of folks got to know who the VIX was earlier this year, where the VIX had told everybody, allow me to reintroduce myself. And it definitely did so. Starting after January, I think it was after the first few days of January, and then essentially it ran up. All right, so something to really look at in moving forward. So let's start off with implied volatility. First off, what is IV? It's pretty much the market's view of the likelihood of changes in a given stock or security price. Now, keep in mind though, investors can use implied volatility to project future moves in supply and demand, and often employ it to price option contracts. So this is really where implied volatility really gets a lot of its shine, where a lot of folks pay attention to that IV. You probably heard about it before, where you hear about things like IV crush and all this other stuff. We'll get into that in a little bit. So let's first grab a pen and paper, because you know what this is. This is a come up series school of investing, and you know how we do. So let's start with what we're going to talk about a little bit. So we're going to get into the basics, then we're going to talk about the mechanics, how it affects options, the good, the bad, and of course the takeaway. So I got maybe 27 minutes left, so let's hope that I can knock these gems out immediately for y'all. So let's first get into, say, for example, what to know about IV. It can often be thought to be a proxy of market risk. So, in general, it increases in bearish markets. So, you probably saw implied volatility significantly spiking when the markets were dropping and when investors believe equity prices will decline over time. IV decreases when the market becomes bullish. So, you probably have seen recently that a lot of the implied volatility for some of the stocks are starting to come down. So this is when investors believe that prices will rise over time. Bearish markets are considered to be undesirable and riskier to the majority of equity investors. So just remember, if it's in a bearish market, then it's like, I ain't gonna touch that. Somebody else take this diaper. Somebody else go change it. So then let's build, shall we? Because let's build on top of that. So when we think about implied volatility, it approximates the future value of the option, and the option's current value is also taken into consideration. So just as a quick little heads up, there are companies out there, or there are stocks out there that literally have significantly throughout, no matter what, they typically trade at high IVs or high implied volatilities than other stocks. Can you mention any tickers in the chat? Anybody? Anybody? Bueller? All right. So so remember what I said. Options with high implied volatility have higher premiums and vice versa. So, for example, if you have a company that's a high momentum growth stock, hey, I see the people out there. Y'all get it. Thank you. Shout outs to Isaiah and everybody else, not Tesla. We see you. So when a company has so again, let me repeat that. When options with high implied volatilities, they have high premiums. So you see them a lot with those high premium stocks. You typically see, because of the fact that there's also there's high implied volatility, which means that their premiums will be higher. And if they don't have high volatility or implied volatility, then that means that their premiums will most likely be lower. AKA, think about it like this. Normally, have you noticed that most of the time individual stocks will have a higher implied volatility versus, say, for example, ETFs, which tend to have lower implied volatility? Very, very interesting. So something to keep in mind. Now, of course, make sure you write this down. Implied volatility is based on probability. I'll repeat it for you. Implied volatility is based on probability. So this means it is only an estimate of future prices rather than an actual indication where they'll go. So essentially, even though investors take implied volatility into account when making investment decisions, this dependence can inevitably impact prices themselves. So I know a lot of y'all are like, so this is guaranteed? Right? So implied volatility is kind of like guaranteed, right? No. Absolutely not. So when we think about it, there is no guarantee that an option price will follow the predicted pattern at all. None whatsoever. So as long as people want to conduct business in the stock market, just know this. There are no guarantees. So some of y'all are like, okay, well, all right, that makes sense. Well, what are the factors? I'm glad you asked. Supply and demand are major determining factors for implied volatility. Another one that has an impact on the premium is time value of the option, or the amount of time until the option expires. You know, that thing that kind of like feeds into that theta in the Greeks. So if we look at an asset that is in high demand, the price tends to rise, right? So let's take a shoe that's out there in the market, or a handbag, or let's say a laptop, or a cell phone, or any type of item that's out there that's in high demand. That price tends to rise. Well, so does the implied volatility, which leads to a higher option premium due to the risky nature of the option. So if that's true on the high side, then the opposite is also true. When there is plenty of supply but not enough market demand, the implied volatility falls. So that means that essentially, if nobody's willing to buy this, look, I'm over here like talking. I'm the CBOE talking about, hey y'all, we got a sale going on, and the option price becomes cheaper. So normally, if you look at an options price chart, you tend to see that essentially that it also has an impact on the options price. So here's the thing. If you look at it, if you get the chance, go look at any options chart for any stock and notice how that option typically starts off at some type of high price. But ain't nobody buying that. The smart money is like, look, man, you do what you do, we'll wait. Whereas you'll have the other folks out there that just can't wait, and they'll go out there and get in, and then they're buying in at the high and then not realizing that, okay, hey, that this just came out. There's going to be probably a potentially lower price. So ultimately, hey, I'm going to wait, and then thus I can come in and buy at a lower premium. Same thing works. Watch that implied volatility because it'll show you something. Now, a short dated option often means in low implied volatility, whereas a long dated option, aka shout out to them leaps in the building, option tends to result in high implied volatility. The difference lies in the amount of time left before the expiration of the contract. Since there is a lengthier time, remember this, since there is longer time, the price has an extended period to move into a favorable price, level in comparison to the strike price. So just remember that, if we really just thinking about it, if you just wait, especially if you're looking to play, like normally, like notice that, especially in this market where we're starting to get a little bit more normal, you'll tend to find that you can get better pricing for longer term options. So just think about like when we saw that the market corrected, the folks in whom which that bought in at the high, it's like now they have to wait for those premiums to come back up versus the folks in whom which that bought in during correction time, then essentially they got in at low premiums and then now they get to ride that elevator up. Now, the good thing is in some cases you can ride the elevator up together, but you have to make sure that that implied volatility will ultimately rise. And as the implied volatility gets higher, then that will also have an effect on the price premium. Okay, so Whoa. Because I've said a lot. So let's talk about the pros. When we think about the pros of, let's say, implied volatility, we think about it in the sense of, here are some simple pros. It quantifies market sentiment and uncertainty. So it gives you a good read of that when you think about it. It also helps to set option prices. So you can see that when the implied volatility drops, and you can probably most certainly guess that most likely those option prices will also come down. And then, of course, it determines a trading strategy, because you can look at implied volatility, given that it is a probability. You can kind of look at that and say, well, Mark, this is something in which that, maybe I may need to wait on this for a second. Now, of course, when you have high momentum stocks, they just always trade at a high implied volatility. So there's nothing that you can do about it. But normally it's like, and that's why, people always say start off with ETFs, because they have low implied volatility. Okay. Now let's talk about them cons. Now we ain't talking about the charlatans out there. We're just talking about the cons, like the things in which that are not good. All right, so we're talking about things in which that it's based solely on prices, not fundamentals. There are no fundamentals attached when we talk about implied volatility. None whatsoever. And then when we think about it, it's sensitive to unexpected factors, aka news and events, economic things. So as we start to see things trigger economically, you start to see that implied volatility can also, aka IV crush, your implied volatility can literally be crushed. So here's the thing to keep in mind. Like, one of the events to take a look at is, this is why a lot of folks, when they play, let's say, like earnings, you have to be the first. It's like normally you're like the first ones in and first ones out, but yet you're riding on 50-50. Look at the implied volatility during the weeks of earnings. You typically see that those implied volatilities start to go significantly high. But then if you're like waiting in there too long, and though that you could be right, you could still not be getting the type of return in which that you expected, because of the fact that the implied volatility has like left the room. So something to also pay attention to. Now, what about this thing called the VIX? Because that's a very, very interesting story here. It's very, very interesting. It must be studied or something. So, which leads me to, huh?
Is that a tornado?
Yes, it is.
Oh,
I wanted to give the best visual that I could to the people when it comes to looking at the VIX. But is it all tornadoes? Well, I give you all a gift tonight. It's called One More Thing. So, has anybody ever heard about the rule of 16? So, don't worry if you haven't heard about it. That's okay. But, have you ever thought, like, has it ever like crossed your mind when you thought about like in the market where you see that, well, we see that the VIX is at this number, like when the VIX was at 32, and yet we constantly saw these moves, these price swings of about 2%. Is that actually something in which that could be predictable? Well, let's talk about it. So on the right side, we had the VIX level. So on one side, we have the VIX level at 16, so which means that expected daily range of about 1 out of 3 times, or 1/3 of the time. So aka 33% of the time, you'll see that there will be a 1% move in the S&P 500. So it implies either a 1% move to the upside or a 1% move to the downside, and so on and so on. So remember when I mentioned 32% or 32 in the VIX, then that equaled a 2% move. Now, of course, you've seen in some cases where it's like you've seen the VIX go all the way up to 80, and clearly that's a 5% move in the market. Now, let's talk about this rule of 16, shall we? Now, of course, RULL. Sorry for my typing. I was going pretty fast before we came on live, so please forgive me there. But pretty much it tells us how options are pricing a stock. So if implied volatility that is what the options market thinks will happen in the future, is let's say 16, it means that the stock is priced to move at 1% each day until expiration. Pretty simple, right? You know, because essentially, like, let's get this further, because, and I'm gonna come on screen for this one. So let's think about it. Here's a quick breakdown of how is it that you can actually calculate it for, say, for example, the position. Now, bear with me. We're gonna do some magic here. Jolynn,
Yes.
how many trading days are there in 2022?
251.
Okay, so if there's 251 trading days in 2022, you do the square root of 251, and that gives you about 15.84. So 15.84 it would be the answer to the square root of 251. So hold on to that number, because now you take, say, for example, what's taking place in the VIX number. So you take that VIX number and then you divide that against, say, for example, that 15.84. So let's say, for example, let's have some magic, shall we?
Yeah.
I'm going to say we are literally, and give me a second here, because we're gonna warm it up here in a second. And I still got time, so today I got time, cuz. So let's say that the VIX is currently at 18.9.
Okay.
Okay, so if we say 18.9 is the VIX number, you divide that by the 15.84, what number does that place us at?
1.19.
All right. Now, we closed today in the S&P 500. The S&P 500 was up 1.23%. And what was the number in the implied volatility again?
That formula was 1.19.
It's not an exact science, but it comes pretty close. And it's 33% of the time, 33% of the time throughout the year, in a trading year, you may find that essentially that it will trade at that price. So let's run that back, shall we? Because I know that I just said a lot there. So here's the formula for literally calculating the rule of 16. Now, of course, everybody's like, wait a minute, Mark, well, what about the 16 number? That's if you round the number up. Some people like to round the number up to 16. Now, I like to be a little bit more thorough. So again, boom, there it is. If you have a calculator, you take the 151, which is the amount of trading, or 251, I'm sorry, 251, which is the amount of trading days in this fiscal year, and then you divide that by, say, for example, or you actually do square root of that. I ain't going to take you guys back to original mathematics and arithmetic, but if you want to use the good old friend Google to say, Google, what's the square root of 251, then that'll give you a 15.84. So 15.84 is the answer to the square root of 251. So then you take whatever the VIX number is, and then you divide that by, and a lot of folks take the opening number or where it closed at, and then they take that number, and then they say, okay, hey, divide that by, say, for example, 15.84. Now, another thing that you could do is you can also take into consideration, that's the high side. Now, here's the cool thing that I tend to do on my side of things, just to give me a particular range. So if you look at it, Jolynn, if we take 15.84 and then divide that by today's VIX number, which is 18.9, where does that place us?
The 1.9 again?
Wait, so 15.84 15.84 divided by 18.9.
Oh, sorry. 18.9 is 0.83.
So that could be essentially your potential low side. So on one side you have the 1.1, and then on the low side you have your 0.8. It's funny because when we look at it, we had a 1.23% in the S&P 500 that ran across the board. Now, if you take into consideration, here's the funny part. Sometimes you can even use that to even look at some potential lows in periods of time throughout the day of where it hits its lowest point due to that volatility. and then essentially where it closes.
Mm.
And that's ultimately how you look at implied volatility and the VIX.
Ta-da! We need like some sound effects.
Yeah, I don't have those yet.
Okay, so I think you should say the opposite of the formula again.
Oh, so again, you still have your 15.84. So then again, you take the 15.84 if you want to see the low side. And yep, somebody just put it up there. VIX is divided by 15.84, or 15.84 is divided by the VIX. You can
That's the
do
question.
both to give you a range.
Mm-hmm.
So on one side, it will give you the low side. On the other side, it will give you the high side. And that it is not, again, it's not guaranteed, but it gives you some data in which that you can use to cross-reference against other things that are out there. And this is specifically slated towards, because the VIX read is a specific reading by CBOE directly to the S&P 500.
Mm-hmm.
So it's not specifically designated towards, the NASDAQ or the Dow. It's just specifically the S&P 500.
Totally. All right. So,
With
well, we have
8 minutes or with 8 minutes to spare.
Right, but we also there were some questions about Tesla. I think it had to do with like delivery predictions or something. Hold on. Let's see what the cousins were talking about. We have okay, many of these questions you answered. Okay, here's a question. This is about AMD. So um how do you think AMD's compound annual growth rate will be impacted post merger compared to 50%?
I think I think that for the first year it's going to stay the same, and then essentially when we start seeing that chip that they were like looking to put together,
Mm-hmm.
between the two, I think that that'll probably start to take place in 2023, at the end of 2023, early 2024, where we start to see that impacts their margins.
Okay, another question. Do you think Tesla will start recycling batteries as part of Master Plan 3?
They already are. So it's not even a part of Master Plan 3. Tesla already works with a company that comes with a former employee that was huge on their battery technology. And then essentially they now have a recycling company where they take in tons of batteries, and guess who's their number one supply? Guess who they supply those batteries to? Or they pretty much, well, okay, let me rephrase that. They take components and then they grind it up back into raw materials, and then they
Mm-hmm.
take those raw materials and then send them back to like places like Panasonic and everything else, and then
Mm-hmm.
they come back to being able to be made into batteries. So we're already starting to see that technology really start to take shape, form, and fashion now. And there's a ton of other players that are within the space, which means that essentially that we get to a place where we don't need to. I think they're able to recycle up to 95% of the actual raw material and reuse it.
Okay, ESG. Can Sony compete with Microsoft?
When it comes to PS5 and Xbox, yeah, I mean Sony has a very distinct playlist and or library of content, as well as game development studios. I mean, I don't think that Sony is going anywhere.
Okay.
Now they need to figure out the situation when it comes to gaming in the cloud, because if they can't figure that out, then yeah, then it may be lights out curtains. Somebody may have just given you a safari punch or something like that, and you're gone. So if they could figure out how to resolve the PlayStation Now business line, where they
Mm-hmm.
can game in the cloud, or even maybe even cross pollinate more with the PC market, then that would be huge for Sony. But if they can't do that, then they're in trouble.
Okay, here's a question about options charts. Do gaps fill in options charts the same as stock charts?
There's an argument to be made on both sides, where it's like some folks are in the ruling of all gaps must be filled, but you have to remember you're playing in a totally different game when it comes to the options market. It's way more volatile than the actual stocks are. So in some cases you can, in other cases probably not.
Okay. Here is another question. Oh wait, you already answered all these yield curve questions. Oh, there was a question about
Shout outs to the cousin that got the materials company right in the chat. Redwood Materials is one of them. Yes.
Oh yeah, I saw that. Okay. So there was a question about, we didn't look at a chart yet. So this question is, can we see a chart from a previous recession with commentary?
4 minutes left to spare?
4 minutes.
Oh, don't make it easy on a guy.
I know.
All right,
And
so who am I? Am I just looking at the SPY?
yeah.
I'm assuming that I'm just looking at the SPY.
Mm-hmm.
All right,
We didn't look at
so
like 2008 or something.
no, I'm gonna even go even further than that. All right, so um, mm, so let's look at it over a 5-year period. See if I can pull it up. Okay, and let's go ahead and hit this transition over here where I do this share screen. Hopefully everybody can see this screen. All right, can everybody see this?
You just got to make it a little bigger. Yeah,
Boom.
that's better.
Okay. And just for the sake of branding, though that we never remove it, but just for now, we'll do it. All right. So when we look at it over periods of time, of course, you see the periods of recession, though that this is more so recession caused by the dot-com bubble bust, more like a market crash. And then of course we had the financial crisis, which is very interesting because we always come back down to previous lows
Mm-hmm.
of the somewhere before, and then of course came back up. I think this was a time of where we had recession here because this was around the time that we had some taper tantrums that were taking place here. And then of course we had the 2015, 2016, but that wasn't really a significant recession there. So it was just more so like a choppy market. And then of course we had 2016 all the way up to 2018. This is around the time that the yield curve had inverted around this period of time here in March of 2018. It's funny how things always take place in March, but check in for it. All right, and then of course we went back up, and that goes to show you something. The markets tend to, get over it, but then again, that's when we started seeing the Fed doing its work, and then boom, we came down, and then of course we had this glorious run starting in 2020 or 2019 all the way up to early 2020. That was a huge run there. And then of course COVID happened, and then again March, um, and then we jumped up again, um, pretty interestingly, and then here we go again. People being spooked about the economy, um, March, and then boom. So all in all, to say, it's like the markets tend to brush off recessions fairly quickly because, again, it's not something to significantly be spooked about. They tend to recover pretty fast. So there you have it.
All right. Thank you for that. So it's now 6:30. Your girl is hungry. I do just want to say that we do have supplemental Sunday this Sunday, 5 o'clock Pacific Standard Time, and that's 8 o'clock Eastern Time. So make sure that you all tune in for that. There will be various, reminders and all that on social media throughout the week. So yeah, you have anything else you want to say, Mark, before we shut it down?
You know, there's been a lot going on in social media, and I tend to stay away from it. But I'm gonna address some things here, and I'm gonna address it very quickly. You know, I made a posting about the word for the culture and how it's being, how we're starting to look away from that. When we say that we are for the culture, we mean that by every shape, form, and fashion. Like we really mean and we really care about the things in which that we do. because of the fact that this is kind of like our mission project. I mean, it's not kind of it. This is our mission project. Jolene in all of her leisurely vibes, giving up a Tuesday night just to sit back and have these lessons, or to sit back and share the knowledge. And of course, myself and how crazy my schedule is. I don't do this for anything else outside of the fact of kindness to each and every single one of you, and in hopes that essentially that this will turn around and literally be reciprocated in the sense of sharing the knowledge with somebody else who will one day want to learn and maybe learn from you. That's the reason why we do it. So, and that's what it means in which that when we say for the culture, we hope that here at the Come Up series, whether it's myself, Jolene, Tivo, AJ, and any other person that you will probably see later on that joins within the fold, we really, really mean that. Now, as it pertains to the folks out there that charge for courses and everything else, that's not our stronghold. That has nothing to do with us. And if they do a great job, we want you to understand this. The Come Up series is established as a standard bar as it pertains to knowledge, wisdom, and information in which that you come and you receive. Anything outside of that literally goes above and beyond what we can do, because of the fact is that, again, we get to teach things that we want to teach. It's not something that's literally within a specific course curriculum format, though check out that School of Investing. It's kind of lit. But at the same token, if there is someone out there that can teach better than what we can do, cool. We're all for that. Do your thing. And if it comes with some type of cost, fine. We don't care. We want you to know that when you watch the Come Up series, this right here will be the standard as it pertains to knowledge and information that you receive. We ain't beefing with nobody. This is financial. This is financial literacy and financial education. When you look at Dan Ives is not like debating against, say, for example, the Kathy Woods of the world, or he's not like trying to bring her down or anything like that. When you look at the folks on Wall Street, though, that they are literally there are competing firms. Anthony Chukumba is not literally trying to bring down a Dan Ives. They are literally trying to share information and everything else so that way their investors are well informed, or that their clients are well informed. You all are our clients in the sense that we want to make sure that you are well informed. The way that it has already been paid, there is nothing that can ultimately come forth that you can ever give us, because of the fact is that our ancestors have already paid the price. They've already paved the way, paid the price. So consider it payment in full. This is something in which that we love doing. We enjoy doing it. And it's like, instead of us spending so much time, wondering about this and that, focus on the things in which that you can have magnanimous impact, which is 1, your portfolio, 2, your family's future, 3, essentially your knowledge and wisdom and literacy growing in this space. We miss more opportunities when we're focused on everything else versus the opportunities that were golden, that were sitting right there in front of us. Please take advantage. Please be kind to one another, because I promise you, it ain't worth it. One of the things that we saw on, everybody's talking about, things that took place at the Oscars. Okay, that's only one representation of what you see. This is another representation of what you see. And when you think of the Come Up series, the only thing that we want you to know of or think about us in the form of few things. We are definitely for the culture because we're from it. 2, essentially, we stand for excellence here. So what Jolene says, no raggedy portfolios. FOMO is not a strategy. Let's go ahead and get this. Let's go ahead and keep the strategy going and stick to the script. And then ultimately, the third part is, because of the fact of how this entire channel started, it started purely out of kindness. So we expect it from each and every single one of you. Go out there and be kind. Until next time, I'm Mark Monroe.
I'm Jolene GC, and the place to be.
And hopefully for each and every single one of you, this has been a Come Up. We'll see y'all next week. Peace, y'all.